Okay, so we will start with equity valuation today. This is our last chapter in the course, uh, and focus is on equity valuations. We are looking at stock valuation only, not valuation of other types of assets. So the first thing that we want to talk about is what do we actually mean by value, right? Value can actually have number of different meanings. So we'll look at very briefly just different types of ways in which we can think about value, and then we'll talk about the concept of intrinsic value and how to go about estimating the intrinsic value. Okay, so some valuation models are pretty straightforward. They are basically valuation using comparables, right? So you can use like a metric like a price to earnings ratio or price to sales ratio for the uh, industry into which your firm belongs, and then you can compare that to the firm's price to earnings ratio to see whether the firm is underpriced or overpriced, right? So that is basically a pretty straightforward and in fact somewhat simplistic way of thinking about value, right? To use like variables like price to earnings or price to sales or price to cash flow, and there are many other metrics like this. So the assumption in that kind of analysis is that uh, if you're using an industry average metric for the firm, then the assumption is that the firm is very similar to an average firm in the industry, and therefore the metrics that apply to the firm should be similar to the industry average. And if they are different, then that is suggesting there is some sort of a mispricing. So, of course, you can find data to do this type of exercise from number of different sources. Edgar is for the 10K and other filings of the firm, and then of course you have Yahoo Finance and other finance websites. All right. So now talking about value, right? Like I said, there are a number of different ways in which we can think about value. You have book value, which is the book value of equity. That is, of course, the value in the balance sheet of the company. That is not reflecting the current market values. Of course, so that is not something that would be very relevant for our purposes. Other is liquidation value. So, if the firm were to be liquidated, all the assets are sold, all the liabilities, all the obligations are satisfied, then what remains is the liquidation value, right? So net amount realized by liquidating the firm and paying out or paying off the obligations. And then you have replacement cost. What would it cost to replace all the firm's assets, right? And this metric, which is known as Tobin's Q, is actually based on this replacement cost idea. Of course, in reality, estimating the replacement cost is pretty tricky. I mean, you cannot, it's very hard to ascertain how much would it cost to replace all the assets of the firm. So in practice, we use simply the book value, right? So for Tobin's Q, it's the ratio of market value to book value. All right. So basically, the idea is when we say value, it can actually mean number of different things. But what we are actually interested in for our purposes is what we are going to refer to as intrinsic value. Okay. For any asset, the intrinsic value is the present value of expected future cash flows. Present value of expected future cash flows. So any asset that generates cash flows, right? So it could be stocks, it could be bonds, it could be real estate, any asset that generates cash flow, you can compute the intrinsic value of that asset by taking the present value of future cash flows that you expect, right? So if you think about bonds, right, you have learned about bond valuation and stock valuation, at least the basic ideas in 320. So what are the future cash flows from a bond? That the future cash flows would be the coupon payments, right? And then you have the principal or par value payment at maturity. So in case of bonds, those future cash flows are known with a lot of certainty. I mean, the interest payments are fixed, and then the par value, and then you discount those at an appropriate discount rate, that reflects the risk of those cash flows, right? So if it's a risky company, the discount rate would be higher. If it's a safer company, the discount rate would be smaller, right? So the discount rate reflects the risk of the cash flow. So you take the present value of those future cash flows at an appropriate discount rate, and that gives you the intrinsic value of the bond. You can apply that same idea to stocks, but of course with the stocks, estimating the future cash flows is a little trickier, right? In case of bonds, you know what those future cash flows are going to be, and plus bonds come with a maturity, so there is an ending time, at the time at which those cash flows stop. You don't have that for stocks, but nonetheless, any cash flow generating asset, you can apply this principle of taking the present value of future cash flows to estimate the intrinsic value, right? If an asset does not generate cash flows, you cannot use this principle there. Like, so if you have, like, say a painting, right, by a famous artist, it does not generate cash flow, so you cannot use this idea to actually estimate the intrinsic value of that painting. So anyways, in case of stocks, of course, one way to do this intrinsic value estimation is to think about dividends as future cash flows, right? So stocks pay dividends. So if you estimate like future dividends, then you can in turn take the present value of those future dividends to come up with the intrinsic value estimate, right? So of course, we already know this idea of holding period return, right? So let's just start from there. Holding period return, right? So if you hold the stock for say 1 year, so you buy the stock today at price P0, you expect to sell it in 1 year at price P1, right? So that's why you have this expected price after time 1. So P1 minus P0. And if the stock pays a dividend, assuming that the dividend is paid at the end, then that also is added here to the numerator. So P1 minus P0 plus D1, right, divided by P0. That's the holding period return from the stock. Okay. So in our subsequent discussion, I'm going to get rid of this expectation signs, right? I'm not going to say expected price after 1 year or expected dividend. I mean, it is implied that these are future values, so you don't know for sure. So those are expectations, okay? But we already know this holding period return calculation, okay? Now, discount rate, right? I mentioned discount rate. Where does K come from? K can be estimated using CAPM or other asset pricing models. So again, we already know this. So in case of stocks, what is the required rate of return for a stock? Here we are calling that as K, and we can use CAPM to estimate that. Okay, and this is our familiar CAPM equation. Okay, here I'm referring to K as the required rate of return. In CAPM equation, you have the expected return, and actually those are identical if the stock is fairly priced, right? So we'll continue to refer to the required rate of return for a stock as K. This would be the discount rate that would be used in our valuation models. Okay. So like I said, for any asset or in particular for stocks, the present value would be the expected value of future cash flows, and K in this case is also referred to as the market capitalization rate. What is the market's consensus of the appropriate required rate of return? So that is K, also referred to as market capitalization rate. Okay. So let me talk about finite horizon. So let's say you buy the stock today and you hold on to it for 1 year. Okay, so you buy the stock today and hold on to it for 1 year, and you sell it after 1 year, right? So when you sell it, you're selling it for price P1, right? So P1 is your price, okay, and you also get this dividend D1. So what are your future cash flows in this one period or 1 year scenario? You sell the stock at P1, so you get this P1 after 1 year, and you get a dividend D1 after 1 year. So what would be the intrinsic value of the stock? Again, present value of expected future cash flows, right? So present value of expected future cash flows. So what are the future cash flows here? Dividend D1 and price P1 that you get from selling the stock. How do you compute the present value? By, since this is after 1 year, you discount this back 1 year. How do you do the discounting? This is simple present value calculation, right? 1 plus k, right? So P1 plus D1 over 1 plus k, that would be the intrinsic value of the stock. Okay. What if you have a 2-year time horizon, right? So here on this document, I have 2-year time horizon. So you buy the stock today, you're looking to hold it for 2 years, and after 2 years you will sell the stock at price P2. So what are your future cash flows? After the first year, you will get a dividend. Let's call that D1, right? You're still holding on to the stock. After year 2, you will get a dividend. Let's call that D2. And at this time, you also sell your stocks at price P2. So for year 2, your cash flows are D2 and P2. Okay. Discount rate is K. So what would be the present value? So that would be again the intrinsic value of the stock, right? So this would be the intrinsic value again. And let me write that down here. Intrinsic value, that is V0. So D1 over 1 plus K, right? You take the first year dividend or first year cash flow, discount it back 1 year. So that would be 1 plus K. And then you take the second year cash flow. So that would be D2 plus P2. You discount it back 2 years. So here you would be dividing by 1 plus K to the 2, right? 1 plus K squared. So the intrinsic value in that case would be D1 over 1 plus K plus D2 plus T2 over 1 plus K squared. If I have 3 years, right, 3-year time horizon, D1 over 1 plus K, D2 over 1 plus K squared, and then I will have a third term here, that would be D3 plus P3 over 1 plus K to the 3, right? So you can keep going like this, and if you have like any holding period H, right, any time horizon H, what would be your intrinsic value calculation there? So D1 over 1 plus K, D2 over 1 plus K squared, and so on. You keep doing that until you reach time H. Time H is the time at which you are going to sell the stock. So that would be, you will be getting the dividend at that time. So that's DH. You will be selling at price PH, and you discount that back to the present by dividing by 1 plus K to the H, right? So this is your general sort of intrinsic value calculation for any time period H, right? Now, if you recall from 320 or maybe other classes, when we talk about dividend discount model, right, we are only discounting dividends. There is no price, there is no selling price. So why only dividends, right? Why not the price that you get from selling the stock? Why is that not discounted? And the reason for that is we are looking at infinite time horizon in those situations, right? So basically the assumption there is you buy the stock today and you hold on to it forever, right? You don't sell the stock at all. So then if you don't sell the stock at all, the only future cash flows that you're getting are the dividends, right? And therefore you just have to discount those future dividends. So that is what you're seeing here, present value of future dividends. And this is unlike this previous cases that we looked at, right? 1 year, 2 year, or H years. This is an infinite stream, right? I mean, this just keeps going because again, your time horizon here is infinite. You have infinite holding period here. So this is an infinite summation, right? It's the present value of all future dividends going on forever, right? So that's why there is no price here. It's only the dividends that you need to discount, but then the time horizon that you're looking at is an infinite time horizon. So how do we use this in practice, right? I mean, even if we estimate like the future dividends and so on, we cannot estimate them to infinity, right? So what we will have to do is we'll have to make some simplifying assumptions regarding how these dividends are changing over time. Okay. One of the simplest assumptions that we can make is that the dividends remain constant. All right. They don't grow at all. So what that means is You have a first year dividend, let's call that D, right? So first year dividend is D. Let me see if I can write that down here. First year dividend is D. Second year dividend, that is also D, and so on. Alright, so every year you are getting the same dividend. So you have D over 1 plus K, D over 1 plus K squared, D over 1 plus K to the 3, and so on. Your dividend does not change at all. It's a constant dividend or fixed dividend. It is not growing over time, right? So that's why we refer to this as the no growth case. It turns out that if your dividends are constant, they are not changing, then this present value calculation, this intrinsic value calculation, this infinite summation in this case is actually equal to just D over K, right? This is for no growth. Okay, this infinite summation is actually just D over K. You can actually do this infinite summation. It's a very simple calculation. The sum of these infinite terms is simply equal to D over K. All right. So if we make that assumption that dividends are not expected to grow at all, they are expected to remain constant, then we can actually arrive at a closed form solution. We can actually arrive at a formula. So in this case, the formula is intrinsic value equals D over K. And here I use V for intrinsic value and P for price. So, generally price might not be same as the intrinsic value. P is the market price. V is the intrinsic value that we get from our model. So they might not be same. But if we were to make the assumption that the stock is fairly priced in the market, then we can sort of use V and P interchangeably. Okay. Now, so this simplifies things. However, this assumption of no growth, it's not a realistic assumption for common stocks, right? You don't expect common stocks dividend to remain fixed. As the companies grow over time, their earnings grow over time, and you expect that they will pay out more and more dividend in future. So dividend is not expected to remain the same, right? So this is not a realistic assumption for common stocks. Preferred stocks, however, tend to pay fixed dividend, right? Their dividend generally does not increase. So we can use this sort of a model for valuing preferred stock, but not for common stock. In case of common stocks, we have to make some assumption about growth. Okay, we have to assume that the dividends are growing, right? And what is the simplest possible assumption we can make regarding growth? We can assume that dividends are growing or are expected to grow at a fixed rate forever, right? So what does that mean? If let's say the growth rate is 5%, meaning that if today's dividend is say $2 per share, then next year's dividend would be higher by 5%. So it would be $2.10. The year after that, the dividends would again increase by 5%. So it would be $2.10 times 1.05, right? So every year dividend you multiply by 1.05, that is 5% constant growth. So here the assumption is dividend is growing at a constant rate forever, right? So that is the constant growth dividend discount model. By the way, this fixed stream of dividends that you get forever, right, in this no growth model, that is basically a perpetuity, right? So again, you might remember perpetuity from your 320. So we're basically taking the present value of a perpetuity, and present value of perpetuity is the perpetuity payment divided by the discount rate, right? So that is essentially what we are doing in this case. Okay, so I'll come back to this example in a minute. Let's first talk about this constant growth model. So again, with the constant growth, so let me write that down. Constant growth dividend discount model, D0. So let's say D0 is current dividend. All right, current dividend. Then what would be D1? D1 would be D0 times 1 plus the growth rate. So uh, growth rate of G, right? So we are going to assume that growth rate is G. So D0 is 1, D0 or D1 is D0 times 1 plus G. D2 would be D1 times 1 plus G. So again it would grow by the same rate, or I can also write this as D0 times 1 plus G to the 2, right? 1 plus G to the 2. Okay, so we can keep going like this. So first year's dividend is D0 times 1 plus G. Second year dividend is D1 times 1 plus G. So again growing at the rate of G every year. So I can write this as D0 times 1 plus G squared as well. And similarly, let's actually do one more. So I can write D3 as D2 times 1 plus G, or this would be actually same as D0 times 1 plus G to the 3. Okay. All right, and so on. So every year the dividend grows at a fixed rate of G. Okay, and if that is the case, or if we make that assumption of constant growth, it turns out that the intrinsic value, so again we are still looking at this infinite summation, except that we have made a specific assumption regarding how these dividends are growing. And for this case of constant growth in dividends, it turns out that the intrinsic value, the summation of those infinite number of terms, is D1 over K minus G. So first year dividend divided by required rate of return minus the growth rate. So D1 over K minus G. Okay, this is again for the specific case when we assume that dividends are expected to grow at the constant rate forever. So this is what we refer to as a growing perpetuity. Okay, and this is the present value of a growing perpetuity. First year's payment divided by K minus G. Okay, now some things are pretty obvious here. Higher the dividend, higher would be the value. So that's pretty intuitive. Higher the required rate of return, lower would be the intrinsic value, right? So riskier firms would have lower value. Higher the growth rate of dividends, higher would be the intrinsic value. So that makes sense. If dividends are growing at a faster rate, if your G is high, your denominator would be smaller and therefore your intrinsic value would be higher. Okay, G cannot be greater than K. If you get G greater than K, that type of growth rate is not sustainable. So you have basically made a mistake in estimating your growth rate. You cannot have that kind of a growth rate. So G has to be less than K in this model, right? So here is a simple example. In this case so this is no growth case, right? So D over K. First year's dividend is $5. Second year's dividend will also be $5. Third year dividend would also be $5, and so on. So this is a fixed growth rate, and so D over K is required is the intrinsic value. K here is 15%. So here you simply do 5 over 15%, right? And that would give you the intrinsic value. This is for the no growth case. For the growth case, here let's say the first year's dividend is $3 and K is 15%, G is 8%, right? So that would be D1 over K minus G. So 3 divided by 15% minus 8%. So in this case, we get the intrinsic value of 42.86. So sometimes you are given D1, right? So your question will tell you the firm expects, or the stock is expected to pay a dividend of $3 next year. So you know that this is D1. Or you might be told that the stock currently pays a dividend of $2 per share. So you know that in that case that is D0, right? So based on how the question is worded, you might see a D0 there or a D1 there. So if you have D1, of course you can use D1 over K minus G, but if you have D0, then we know that D1 is D0 times 1 plus G. So in that case you will have to use this relationship, right? D0 times 1 plus G over K minus G, right? So here we are substituting D1 for D0 times 1 plus G.